All right, hi. We have Laird Cagan from Cagan McAfee Capital Partners, and it's an honor to have you here, Laird. Nice to meet you.
Thank you. Nice to meet you.
I'm Kenzie. I'm one of the moderators here for F50. So I just have a few general questions here for you, Laird. Number one question, everybody want to know here is that how did you get into venture capital in the first place?
So I started my career, I was an engineering undergrad and master's at Stanford. I was more interested in finance, so I went back to Stanford Business School. I worked during business school for 1 year as an intern at Crosspoint Venture Partners, Crosspoint 1, and doing small seed deal review, looking at business plans for a year. Then when I graduated, I worked on Wall Street for 5 years. I worked at Goldman Sachs doing large deal M&A transactions, but I was more interested in entrepreneurial. So in 1990, I just decided to go off on my own. I started investing in and joining early stage, high growth tech companies, helping them grow, helping them do strategy, M&A, and capital raising. I've been doing that since 1990.
Wow, so you've gone through a few cycles, right? You've seen a few winter and spring. So what would you describe the ecosystem now? Is it spring or is it winter?
I think we're in for a soft landing. I think we have been through a period of a little bit of exuberance with the increase in liquidity. So you have these periods of time, as you mentioned, when you have a down cycle, liquidity comes out of the market. 2008 was an extreme position. In that, 2001 was extreme, but it was only technology. 2008 was the entire world. So now it took till about 2012 or 13 for liquidity to start coming back in, came back in a big way. People were looking for where do I put my capital. A lot went into the growth companies. So you had this extreme amount of capital coming into the VC firms. They're putting it to work. That's pulling back. I think it's natural. I think it's normal that they should be slowing down. But I don't think we're going to see a major crash correction like we did in either 2001 or 2009. And I think it's just going back to a normal level of investment. I think we're going to see a lot of companies have a decrease in valuation at the highest level. I think we're going to see a slowdown in the number of companies that were funded because it was a little bit of exuberance. But I think good companies will still get funded. The IPO market's been on the sideline for a long time. I think that's going to come back. But it's going to be a rational IPO market. It's not going to be an exuberant market. So companies that have been at high prices privately, I think there's risk because they have higher end. Where that goes, what price that comes in at. But I think you'll see there is still liquidity in the market. There's a lot of people looking for where should I invest in the marketplace. That money is going into technology. Technology still seems to growth everywhere around the world, from America to China, to Europe, to India, and people are looking for where do I put my capital, and a lot of that's going to wind up in tech companies. So I think we're going to see sustained growth. I think it's been exuberant. It's going to come down a little bit, but we're going to see that continue.
Zooming in a little bit, what about compared to 2014 and 15? Zooming in a little bit. Is this a little bit better this year than last year in 2015, or is this we don't know yet?
Well, I think, as I said, I think we're going to have a decrease in amount of capital that's going to be put to work, the pace at which money is going to be put to work, and I think it's going to slow down. I think you're going to get back to a more normalized level, which is probably 2013, maybe 14, probably 2013 kind of level. But I think that's good. You can't keep